In my last video, I talked to you again about the idea that a great investment strategy is a great strategy that you can and will stick to. And it's really that last part that is extremely difficult. You must have a strategy that you can stick to. And that means the right balance between a portfolio that can generate great returns and also is less likely to lose a lot of money even in the short term, even having a short-term blip that causes it to lose a lot of value. And I was making an important point about drawdowns, and today I want to talk about that a little bit more. I'll talk about what drawdowns are and why they matter. I'm Ken Bauso. I'm a CFA charter holder. I spent my career on Wall Street and in the financial markets, and it always made me absolutely nuts to see the horrible reporting, explanations, and misinformation and the resulting poor understanding among the general public about our financial and economic world. And that's why I do this podcast. So please subscribe and hit the bell. Even better, you can send me an email so I can add you to my distribution list. The last video, I talked about the fact that a strategy that minimizes drawdowns will be much easier to stick with compared to a strategy that doesn't. I cited a passage from Warren Buffett's 2013 letter that started with him saying, quote, "The main danger is that the timid or beginning investor will enter the market at a time of extreme exuberance and then become disillusioned when paper losses occur." Now, personally, I would expand on that. He says the timid or beginning investor. I would definitely expand on that. I think this is a problem not just for the timid or beginning investors, and I'll tell you why. First, I showed you two portfolios. One was a portfolio that Buffett references in that letter, which has great returns, over 10%, I think it's about 10.4%, but it's very volatile and has high drawdowns. I also showed the permanent portfolio, which has a lower annualized return in the eights, mid-eights, 8-point-something% a year annualized, but it has much lower drawdowns. And I made the point that the second portfolio would be much easier for an investor to stick with. So let's just take a step back for a moment. What are drawdowns? Drawdowns is very simply the difference between the most your investment account was ever worth and then the lowest it became worth after that. Okay, so for example, if you have a portfolio that's worth $70,000, right, and you invest and do well, that portfolio grows to $100,000. Okay, at that point, let's say lots of bad things happen, and the lowest point it goes down to after that is $55,000. Okay, so that is a $45,000 drawdown. You had to live through one day seeing your portfolio worth $100,000 to at some later point seeing it was only worth $55,000. And those drawdowns are much more difficult to live through than you think. Psychology plays an important role in sticking to an investment plan. And human beings do a very poor job of being able to accurately predict how they will feel in the future. And I don't mean in aggregate. I mean, you do a bad job of being able to predict how you will feel in the future. I do a bad job of being able to predict how I will feel in the future in certain circumstances. I give you the particular circumstance, you tell me how you'll feel. Believe it or not, we do a very bad job at this. So why is this the case? What we've talked about is just looking exclusively at the value of your portfolio. But unfortunately, a lot of the bad things that can go on in the economy are all correlated. They all tend to happen at the same time. Okay, so at the same time that you've seen your portfolio go from $100,000 to $55,000, let's say, just to pick out what a bad drawdown would look like. During the last recession, to use that as an example, there were a lot of other things going on at the same time. So for example, the value of your house, if you own your house, was going down. Your earnings at your job were probably less than you thought, meaning if you thought maybe you'd get a raise, that probably didn't happen. If you have a bonus-based job, you probably got much less of a bonus than you thought, or no bonus. At the same time, you can see the economy as a whole is shifting into an environment where people are being laid off. So the things you thought you might do if you got laid off now look like you probably will not be able to do that. It's much more likely that some member of your family will be experiencing some financial distress. And in addition to that, stocks are going down. The value of your portfolio is also going down. So all these things are correlated. They all happen at the same time. And you can't control almost any of them, okay? If you want to make the pain stop, you really can't, except regarding your portfolio, okay? All you have to do is click a button and you remove the element of further losses in your portfolio, okay? That's how reasonable people who have thought through a plan end up selling at a really bad time to sell in the market and locking in losses. So let's go back to that point that Warren Buffett said. The main danger is that the timid or beginning investor will enter the market at a time of extreme exuberance and then become disillusioned when paper losses occur. So paper losses, see that graph I showed you of what the strategy Warren Buffett referenced, if someone just held on the whole time, they would have performed quite well. But when the paper losses occurred, if you sold, then that would turn what was a very good strategy into a horrible strategy. Okay, so this reminds me of a general point more specifically when it comes to investing. When I was living in London, I remember going out to lunch with a good friend of mine who's a very successful hedge fund manager. He made this point, which I've heard it made lots of times since then too. Losing money hurts so much more than making money feels good. I'm sure that's tied to human evolution in some way, but that's for a different podcast. Thanks for listening. Don't forget to subscribe and also hit the bell so you'll be notified when I post a new comment.